Hi guys, I'm Tyler Laundon, Chief Analyst of Cabot Small Cap Confidential and Cabot Early Opportunities, here with your Cabot Weekly Review. It is Thursday, March 28th, and it's just after 2 o'clock p.m. Eastern Time. Of course, the market is closed tomorrow for the Friday Easter holiday. I'm recording this later in the afternoon than we normally do, just to try to capture as much of the day's action as we can, because it is kind of a short week. But let's move on to the market. So, as you can see here, chart of the S&P 500, yeah, it's maybe new highs, sort of new highs. Pretty decent week, although there are areas of the market like small caps that have done better. We'll talk more about that in a minute. First, I just want to back up to the Fed meeting from last week, touch on that very quickly because that's kind of been the theme this week. Analysts, investors, and markets sort of digesting what the Fed said, which generally was better as far as the market is concerned than we really were expecting. So the Fed maintained its projection of 325 basis point cuts this year. They also increased their forecast for GDP to grow at 2.1% instead of 1.4%. At the same time, they increased their outlook for the PCED inflation rate to 2.6% from 2.4%. We're going to get the latest reading on that tomorrow. Of course, the market will be closed, so that will be digested on Monday. But that's going to be something to watch for sure. And the Fed also marginally lowered their forecast for the unemployment rate to 4% from 4.1%. So when you step back, you kind of think about this. Basically, the Fed is saying they think inflation is close enough to 2% to err on the side of slightly easing a bit earlier, rather than waiting too long and causing a recession by holding rates too high for too long. That doesn't mean they're going to go gangbusters and start slashing rates like crazy. Like I said, 3 cuts this year is what's projected, with about a 60 to 70% probability of that first cut coming in June. So we'll see how that goes. Obviously, that's like a big, macro driver of bullishness for the market. We also have the end of the Q4 earnings season. Of course, the first quarter of 2024 will close today. So going to be looking forward to the next earnings season starting in a few weeks or toward the end of April and into May. And I just went over the latest consensus estimates for both the S&P 500 and the S&P 600, and they look pretty good. So annual revenue growth expectations for the S&P 500 about 5 to 6% over the next 2 years, with earnings growth rates about double that. So that's a pretty good backdrop. Small cap revenue estimates a little bit slower, 1 to 5%, but EPS growth 6 to 16% over the next 2 years. Of course, those are just estimates. They're going to change based on how things go. But when we combine potentially falling rates with good revenue and earnings growth at the index level, that's a pretty good backdrop for the market. And of course, we also have a bunch of money on the sidelines in money market funds, which are yielding 4.5 to 5% right now. If and as the Fed starts to cut rates, those yields will go down. That could be another tailwind for the market. I'm not saying that the market is going to go gangbusters, straight up over the next 2 years. But again, when we kind of step back and we think about what we're coming out of, the market just eclipsed. It's got back to break even basically from the 2022-2023 drawdown back on January 19th. And typically we see that these bull markets do last for quite some time, especially when we have these big macro tailwinds. In fact, I just read this week that during the previous 8 bull markets, the recoveries lasted an average of 3.5 years from that point of recovering all losses. So again, not saying that we're going to go straight up from here. We won't. There will be corrections along the way, but again, pretty decent backdrop, supportive of pretty good stock market returns for a few years here. All right, let's move on. Just quickly look at these other indexes. The NASDAQ this week basically flat, but still looking pretty good. and small cap index. This is where the action has been. It is just breaking out above the December highs today, which is nice to see. Shouldn't come as a surprise that I've been pulling for small caps. I think that they have the potential to outperform pretty significantly, just given they're trading at a discount and they've been lagging for years, honestly. So some pent-up potential there. Here we have a chart of the 10-year yield, which has come down over the last 2 weeks. All right, let's get back into small caps and into some stocks and ETFs. This is the IJR, so it's the S&P 600 small cap ETF. Chart looks just like it would for the index, but of course the number values are different. But again, moving higher today through that, what is the 110.5 level here with the ETF. One of the, or a couple of the areas that have been helping the small cap index move higher is financials. So of course there's a whole kind of potential mess going on with small cap and small and mid-market regional banks. But what we need to see, because there is a pretty decent weighting financials in the small cap index, is for the small cap financial component of it to perk up. And that is what is happening. At least it has been for the last couple of weeks. So you can see that here. If you look at the XLF, which is the large cap financial ETF, you'll see it looks much, much better. But again, we kind of need decent financial performance for the small cap index to get going. And we're starting to see that. Also, we have the industrials here. This is the PSCI, the small cap specific industrial ETF, starting to gain some momentum. And also the materials ETF, the PSCM, the small cap materials ETF. All right, I think the theme really for this week's video is kind of like broadening your perspective. So this week, again, I knew it was the end of the first quarter. I spent a lot of time just kind of looking around the market, thinking more broadly about what we could be doing in the two services that I run to kind of help diversify our exposure. We've all been so focused on tech and AI and all that, and obviously that a lot of that is still going very well. But as we see the market rally sort of broaden out into other areas, it really does pay to sort of broaden your horizons. Disney is a name, obviously not small cap, but that a lot of people have kind of forgotten about, I think, because there's been so much going on down in Florida. But decent reaction back in February to the earnings report, and the stock has really taken off over the last couple of weeks. So Disney, one of those names not to completely forget about. If we zoom out to the weekly chart, you can see there's still quite a bit of white space above before Disney gets back to where it was when everybody thought that Disney Plus was the future. Allstate, another kind of boring name, obviously an insurer, one of the big auto insurers. So the auto insurance market has been total turmoil for the last couple of years as inflation took off and the cost to repair cars went high, and also the cost for people that got banged up to get themselves repaired. Basically, insurers didn't really want to take on new customers. They needed to get rate increases passed through. So that's begun to happen. And if you go and you listen to what a lot of management teams at the big auto insurers have said, they're kind of looking to get back into growth mode. And we can see that starting to lead to a lot of interest in these stocks. So here's Allstate, like I said, ticker symbol ALL. And similarly, Progressive, ticker symbol PGR, another big insurer. If you want to move down market, this relatively speculative name, Root, ticker symbol ROOT, they're exposed to the property and casualty insurance market, but there's a lot of company specific stuff going on here. Basically, there is a whole mess going on, which I'm not going to get into, but as you can see, there's been a lot of interest in the stock, which has gone from about $10 to $60 since February. Do your own research on this one. I just wanted to kind of flag it as sort of an indication of interest in the smaller and more speculative space in the auto insurance market. Okay. Energy has been garnering more headlines this week. Of course, you have names like ExxonMobil, which you see here, but we can go down market a little bit to names like Targa Resources. I can pull up the data box here so you can see market cap in here. 25 billion for Targa, TRGP, as well as Enerplus, ticker symbol ERF. I just ran a screen for decent performing oil and gas names, and these are some of the names that came up. 4.05 billion market cap for Enerplus. And of course, Antero Resources, 8.85 billion market cap, starting to gather some momentum as well. And then Tidewater, 4.8. They provide services to oil and gas offshore, I believe. So that's Tidewater. I mentioned financials. So here we have the XLF, large cap financial ETF, looking pretty good. There were some notes out this week and last week about the big money center banks. So that's JP Morgan, which is obviously doing pretty well here, JPM, and Citigroup. And if you want to go more specialized, you have the ARK FinTech ETF, the ARKF. I'm not necessarily a big fan of going into like small cap specific banks, regional banks. It's not my space. So that's why I don't have any of those names for you. But again, if I'm looking at financial exposure, it's usually going to be pretty broad based, just so I don't have any stock specific risk, unless we get into a fintech name. But I didn't screen for any of those guys this week, just the ARKF. Turning to another growth area of the market, so medtech. It's been a little bit slow lately in medtech world, but this week we heard some rumors that Johnson & Johnson might be kicking the tires on Shockwave, ticker symbol SWAV, which led to a pretty nice move here for Shockwave. And also this morning, I think Piper Sandler came out, initiated on Transmedics, TMDX, small cap medtech name, kind of revolutionizing the organ transplant market, as well as the logistics part of that market. Saw a nice bump in that stock this morning, and it's sort of faded since. But Piper also initiated on SIBN, ticker symbol SIBN. So I think medtech could be an area that's lagged a little bit, but it's certainly worth keeping an eye on. And let's see what else. I think we have a couple more names here in the IPO market. So we had last week a couple of pretty significant IPOs with Reddit. Throw that name up. Obviously that stock kind of surged and has come back down. But it's been really nice to see, for me, I'm always looking for new opportunities and kind of unknown names. So follow the IPO market, which super slow in 2022 and 2023, finally starting to have some decent sized offerings, not just offerings, but companies like with some size to them. Reddit, and the other one from last week was ALAB. That's a Astera Lab, ALAB. Both of those pretty high profile names. I'm not saying like jump into them right now by any stretch of the imagination. Typically I like to wait until after lockup expiration has passed, but it's been nice to see some action there. And also Cart. So this is Instacart, ticker symbol CART. It's had a good couple of weeks. And lastly, another IPO from last year that's past expiration is CAVA Group Restaurants, ticker symbol CAVA. So again, guys, kind of the theme for this week is I think it's time to step back, broaden your horizons a little bit, maybe look at some areas of the market that you weren't so focused on, and kind of see if there's some gaps in your portfolio where a little bit more diversification might help. That's really the message for this week. I'm done for the week. Tomorrow, Friday, market is closed and Cabot will be closed, but we'll look forward to seeing you again next week and hope you have a nice long holiday weekend. Take care.